So it's a great question, Tom. And I mean, I like to say we have these drawdown charts we highlight in our marketing deck. It feels a whole lot worse than that 2%. And that just speaks to sort of the pain that we've seen under the surface. Look, we have an 8150 target over the next 12 months. So sort of a mid 2027 number at this point. But we have never said that it was going to get there in a straight line. And so we have been looking for pullbacks that would be, frankly, no worse than 5 to 10%. I do think this earnings season is a little bit tricky because on the one hand, the bar is just incredibly high. We had 30% growth last reporting season, last quarter. We're tracking it like 25 and change now. Seems very difficult to not, sort of come out of this with a decelerating growth environment. At the same time, we've seen that 25% move up over the last week. So I think it's a little bit tricky in here. I do think the bar is high. I think the commentary is going to matter tremendously.
So it feels like the bar for second quarter earnings is really high. But yet this market has cleared it seemingly every single quarter. What's your confidence level for this quarter?
So, Paul, if you had asked me that question like 3 weeks ago, I didn't feel so good. I feel a little bit better now, and that's because some of the stats I track have actually worsened. And that's looking at earnings sentiment or the rate of upward revisions. And so we have seen that now start to trend down. It's still showing upward revisions generally, but just at a slower pace. And we're seeing that downtick in earnings sentiment now for the S&P 500, the top 10 market cap names, and the other 490 stocks in the index. So I think there's some good news there. One sector we upgraded recently was actually the consumer discretionary sector. We did not go to overweight, but we took our long-standing underweight off and went back to neutral. And that's a sector I'm really curious. We won't get those until a little bit later in reporting season for the most part. But everybody is negative on that sector. I just did a survey of my analysts, and across the globe, Europe, Canada, Australia, the US, there was pretty deep negativity on staples, discretionary, the comm services sector, which is tangentially consumer. And we found that the valuations have been looking better.
Right.
We've been looking at the UMich survey where you're seeing upticks across cohorts, gender, income, education, partisanship. So we felt like that was an area maybe the pessimism had been too deep.
Lori, I have to pause the show because I'm showing off my Red Sox jacket to Anne-Marie Horton as she walks by, just because the Red Sox have won 13 in a row and the dreaded Yankees. What a shock. Anne-Marie Horton is ignoring me.
Yes.
Like every woman this weekend. Paul, continue the show with Lori Calvasina.
Lori, talk to us about small and mid-cap stocks here. We've seen the Russell 2000 really do a good job vis-a-vis the S&P 500 this year.
It's interesting. It is a tale of two indexes, though. Remember, we just went through the Russell reconstitution, and a lot of the high flyers got booted up to big cap land. One of the things we saw, Paul, was that if you looked at the Russell 2000, a market cap weighted median PE, just a forward-looking metric, prior to the reconstitution, that was over 20 times, and it kind of blown through the highs of 19 that had been the recent ceiling. Post-reconstitution, it pulled back down to average, a little above 17 times. So we pulled the froth out of that index when we pushed the high flyers out, but we didn't make the index look cheap. And I think that's a good, sort of microcosm for how to think about the space. Defrost, but not deeply compelling. If we get back into a conversation about Fed hikes going forward, that's a negative for this space. On the other hand, we are seeing, various cyclical indicators turn up, like ISM new orders, jobs growth is accelerating, GDP forecasts are inching up. Now, all of those things are put at risk by this re-escalation of the war. But there are some good tailwinds on the fundamental side. I just don't know that we have a ton of valuation room here.
I mean, Lori, I got the Spanish stock market. I'm doing that for the World Cup, Lori. Stay with me here. I'm doing the Spanish stock market up 34%, 12 months trailing. Dow Jones up 18%, S&P up 18%, all in NASDAQ up 22%. Do we feel like a bull market?
It feels like a market that takes a couple of steps forwards and then a step back. And I think that it's climbing the wall of worry, so to speak. I just covered the U.S. I know that there have been sort of allegations of froth. I'm not seeing it in my valuation data. I'm not seeing it in my positioning data. Perhaps the Conference Board has a good time series on stock market optimism from consumers over the next 12 months. That is pretty elevated. But institutions do not feel frothy to me when I look at that data.
Paul, it's a headline made for Lori Calvasina. Google plans new chip to boost AI model efficiency. It just doesn't end.
No. That's according to the information. So some more news. Google stock's up 1.25% pre-market here. Lori, as we do come into some technology earnings this week and next, how do you think the market's looking at the AI trade broadly defined these days?
That's the question.
It's a great question, Paul. And, if you think about, sort of this unwind of the semiconductors that we've seen, I was hearing back in mid-May, and I think we've probably talked about this a couple times on this show, but I was hearing back in mid-May from European investors that they wanted to take profits, on some of the semi-AI type names, some of the winners in their portfolio, frankly. So, while I don't think that this price action has been fun for anybody involved, I do think that, we were sort of hearing the seeds of this for a while. Now, what I'm hearing more recently, and I would say it's not all clients, but some clients, and my RBC colleagues are, hearing this as well, is that the hedge fund community is tending to view what's been happening as more of a positioning momentum factor unwind, not anything fundamental. Now, when I talk to some of my more long-only oriented clients, some of these existential AI fears, we're at peak CapEx growth rates, things are going to slow. Those things are perking up in some conversations, but I would say by and large, most people I talk to think that this is just a positioning move. It's late innings. There's going to be an opportunity to buy some of this stuff back.
Late innings is baseball talk. That's when the Red Sox win.
Sure.
13 in a row.